your work is centered on M&A financial due diligence with a specialized focus on quality of earnings analysis. For many entrepreneurs, like considering buying or selling, this term is critical but often misunderstood. Can you explain what a quality of earnings analysis involves and why it's a critical step in merger and acquisitions?
Absolutely. And I'll start with the basics. Due diligence, in particular, the literal meaning of the term is reasonable care or proper attention. Um, uh, from legal terminology, what it essentially means is all the steps that a reasonable person will take before entering into an agreement or a transaction. In the M&A context, due diligence encompasses all the activities to validate and inspect the financials, the operational capabilities, the environmental liabilities, the debt obligations, human resources, systems, and processes in place of a company. Financial due diligence, in particular, is an exercise which involves comprehensive review of the financial health of a company that is being acquired. We are examining everything from revenue and cost structures to working capital needs and historical performance trends. What it essentially does is it answers some fundamental questions. Are the financials accurate? What risks exist? Are the earnings sustainable? Is the business poised for growth in the future? And more importantly, what is the business truly worth? Within financial due diligence, quality of earnings is the crown jewel. It's the most critical component. The due diligence exercise primarily may encompass looking into tax obligations, debt obligations, capital expenditure requirements. A QoE, on the other hand, basically reveals and determines the true sustainable earnings power of a company by adjusting for one-time items, non-recurring expenses, and accounting anomalies. I'll give you an example. Imagine a company into manufacturing generating $2 million of EBITDA. Now, on the surface, it looks pretty solid. But a QoE analysis may reveal that $200,000 came from a one-time insurance claim. Owner's spouse is drawing payroll but is not involved in the business. And there is critical equipment that requires capex but is being deferred by the seller. Now, suddenly, that $2 million looks or comes closer to $1.5 million. This is important in M&A context because buyers generally pay a multiple of earnings to acquire a business. If you're paying 3 times of EBITDA and you've overestimated earnings by $500,000, you've overpaid $1.5 billion. That means the buyer basically is not driving the right value or synergies from that particular acquisition. A QoE exercise protects buyers from overpayment and helps sellers present businesses accurately, leading to smoother transactions and enable fewer post-close disputes.